Intangible assets. I'm going to talk about these first 4 learning objectives today. And let's see if we put that in here. That's these right here. And we're going to focus on the characteristics. We're going to determine when to capitalize and later amortize intangible assets, and when those costs that really do create intangible assets are not eligible, or we do not capitalize and we actually expense them. We're going to talk about the different types of intangible assets, and then we're going to focus a little bit about the conceptual issues and how we account for goodwill. In a later video, we'll deal with these other things that include impairments for intangible assets, research and development costs, and how intangible assets are presented on the financial statements. So with that, this is basically a different view of what I've just talked about, the intangible asset issues. We're going to be talking about the characteristics and valuation and amortization, the different types of intangibles, that's coming right up, and we'll talk about impairments. And that's going to come up, as I said earlier, in a separate video. In these last 2 are research and development costs and presentation of intangibles on the balance sheet and income statement. So let's get started. So characteristics of intangible assets, basically they have 2 main characteristics. They lack physical existence, and they are not financial instruments. Think of all the things that are kind of either directly financial instruments or are like financial instruments. For example, we talk about cash. Cash is in a bank, and it lacks physical existence, but it's not an intangible asset. Same thing with accounts receivable. Certainly marketable securities. All of these things are assets that lack physical existence, but they don't count as what we're talking about here as intangible assets. Intangible assets fall into these categories: patents, copyrights, franchises or licenses, trademarks, goodwill. So how do they get valued? Like most assets, they initially get recorded at cost. And this includes all of the costs necessary to make the intangible asset ready for its intended use. And generally, these additional costs include lawyer fees. Notice that, and one of the things we're going to be talking about throughout the discussion of intangible assets is how intangible assets is accounted for depends on how they arose. So if you acquire an intangible asset by buying it from another firm, it's generally capitalized. If you create it in-house, it is generally expensed, these internally created intangibles. Things like expenditures on wages and salaries, which keep our employees coming back, and sometimes even keep our customers from coming back if we spend more on wages and salaries, or on research and development, or advertising expense. All of those costs get expensed immediately, even though over time they do build up goodwill, in the sense that customers have a habit of coming in the door. Employees have a habit of coming to work, and neither one of those have to happen, but they do, and they create value for the firm. Internally created intangibles, we only can capitalize the costs when we get to the point where we can create a legal right to them, and we say we acquire a patent, and the legal costs of acquiring the patent can be capitalized, that is, debited asset. Once we capitalize intangible asset costs, then we amortize them over time for certain limited life intangibles like patents and copyrights. And we typically don't have an accumulated amortization or a contra asset. We just usually credit the asset account directly, although it is possible to have accumulated amortization. Indefinite life intangibles, where there's no foreseeable limit on the time that the asset is expected to provide cash flows. And for these, we don't amortize, and we typically have an annual impairment test to see if there's been an impairment in the value of those indefinite intangibles. So we talk about how it's accounted for, the cost of intangible assets. We basically break it down between limited life intangible assets and indefinite life intangible assets. When we buy from somebody else, all of these get purchased. All of these purchase costs get capitalized. As a general rule, internally created assets, intangible assets, are expensed except for these direct legal costs. And then, regardless of how they came about, limited life intangible assets get amortized over their useful life, and unlimited or indefinite life intangibles do not get amortized. The impairment test that we'll talk about in a later video is slightly different. For limited life intangibles, it's the same impairment test that we use for fixed assets, and that is a two-step process. We start with recoverability, and then we move on to the fair value test. For indefinite life intangibles, like Goodwill, trademarks are a couple of examples, it's really only a fair value test. It's a two-step fair value test for Goodwill, but we'll talk about that later. The categories of intangibles that we deal with are marketing-related, customer-related, artistic-related, contract-related, technology, and goodwill. Starting with marketing-related, these generally are trademarks or trade names. It might be a URL or even a non-compete agreement. These are examples of marketing-related intangibles. As a general rule, they don't go away, although it is possible certainly to have them disappear. For example, a non-compete agreement might only last for 5 years, and we would amortize it over that 5-year period. But as a general rule, trademarks, trade names, newspaper mastheads, internet domain names can be renewed at minimal cost, and therefore we don't amortize those costs over time. Customer-related intangible assets, email lists, for example, customer lists, these kinds of things. One I recall in a bank was the amount of less than market rate interest deposits that the bank has. So they've got, let's say you have a bunch of customers who are willing to accept 0.5% on their passbook savings account when they could be earning 2% or something like that. And that list of passbook savings depositors, the people that are depositing with your bank, has value. It's a customer-related intangible asset. And in the case that I recall, they certainly assigned value to it. It gets amortized to expense over its useful life. And notice that things like email lists, you're going to get greater benefit in the earlier years as those email lists are more relevant. Over time, people switch email accounts, and that email list becomes less valuable. So it may not be straight line amortization. It might be some sort of accelerated method to match the benefits with the cost in the relevant period. Here's an example of a customer list that was acquired. Green Market acquired the customer list of a large newspaper for $6 million on January 1, year 1. Green Market expects to benefit from the information evenly over a 3-year period. Record the purchase of the customer list and the amortization, and take a look at that. On the day that we acquire it, we're going to have a customer list and a credit to cash for $6 million. And then at the end of the first year, and in fact at the end of the second year and the third year, we have amortization. You can call it amortization expense, or more specifically customer list expense, and a credit to the asset. And each year we're using up that intangible asset. That's a limited life intangible, and those limited life intangible assets get amortized, just like this other kind here that we're dealing with has a copyright. Copyrights, when we acquire them, we have some acquisition costs. If you acquire them and you spend money on a play or you write the play yourself, typically it's only the legal costs that get capitalized, and then they get amortized over their useful life, which, as it points out here, is the life of the creator plus 70 years. But that does not necessarily mean it's the useful life. The useful life may be much, much shorter than that. So you take the lesser of the legal life, which is stated here, or the useful life. Contract-related intangible assets include franchises and broadcast rights and construction permits and those kinds of things. Typically they have an indefinite life, but sometimes they have a limited life. In either case, if it's a limited life, you amortize. Indefinite life, you don't. Technology-related, typically we're talking about patents here. A patent gives the holder the exclusive use of that idea. Someone had a unique idea, and they now have the right to benefit from that idea. We capitalize the cost of buying a patent, or if we've developed it in-house, just the cost of acquiring it, these legal fees. Indeed, if we get involved in a lawsuit to defend our patent, and we successfully defend that patent, those legal fees get debited to the patent and become an asset, because we have now a stronger patent in our common law system. Normally, as I pointed out earlier, we expense R&D costs that are incurred in order to develop the patent. So here's another example. Harcourt incurs $180,000 in legal costs to successfully defend a patent. The patent's useful life is 20 years, amortized on a straight line basis. Harcourt records the legal fees and the amortization at the end of the year as follows. January 1, we pay $180,000, which is a credit to cash and a debit to the patent. The reason it's debited to the patent is that it was successfully defended. At the end of the year, however, we're going to amortize that by debiting the patent amortization expense and crediting patent for 1/20th. We're spreading that out. In this case, straight line, and in fact, most cases straight line, but there certainly is conceptual foundation for maybe taking some accelerated method if you're getting more benefits in the earlier years from a patent. The last intangible we'll discuss is goodwill. And this one is only recorded when an entire business is purchased, because goodwill cannot be separated from the business as a whole. So goodwill is recorded as the excess of the purchase price over the fair market value of the identifiable net assets that we acquire. So let's talk about what this means. The fair market value of the identifiable net assets acquired means that we don't look to the value that's on the books of the company that we acquire. We don't care about that. And we look to all the identifiable assets. That includes other intangible assets. It may include patents and trademarks. customer lists, and those kinds of things. And we subtract, in order to get to the net part, we subtract the fair market value of the debt that we owe, that we're taking on in this acquisition. And the excess, the purchase price over the fair market value of all of these net assets, is the price that we're paying for things like the habit that our customers have of buying from this firm, the habit that our employees have of coming to work. Neither one of those things have to continue, but we've developed a good brand name, a good name in the marketplace, and as a result, that name gives us some value going forward. Notice, however, that if we don't buy another company and we develop Goodwill in-house, a company like Coca-Cola internally generates Goodwill, but you won't see much Goodwill on the books of Coca-Cola, except for companies that it has acquired and the brands that came with that. So let's take a look at an example. Here's Multi-Diversified decides that it needs a parts division to supplement its existing tractor dealership. The president of Multi-Diversified is interested in buying TractorLing. And here's what TractorLing's balance sheet looks like. And notice that this is on TractorLing's books. And in particular, notice that the inventories are $42,000 and the property, plant, and equipment is $153,000. Now, when we acquire that company, we don't care what was on the books. All we're going to do is look at the fair values of these, and notice that where we now have $205,000 and $122,000, much higher values for that. TractorLing, we offer $400,000 for this company. What is the value of the Goodwill? Well, the Goodwill is the price paid, that's the $400,000, over the fair value of the net assets, those identifiable. So we can see the value of that Goodwill is going to be the $50,000, the excess of the price paid over the fair value of the net assets. Why do we use the fair value of liabilities? And sometimes that comes up, and you say, well, how could the fair value and the book value of liabilities be different? Well, we already know that. So what if TractorLing had issued $55,000 of 8% debt, and the interest rate on those in the current in the current market is 12%. So those bonds that we issued, or the TractorLing issued, at 8%, well, they're not worth a full $55,000 if they're paying if the market rate is 12%. So the value of those bonds in the open market is going to be less than $55,000. And we, as the acquirer of the company, could go out and buy back those bonds from the market at less than $55,000. So we would use the market value of the debt that we acquire, if there is the market value. And that's what we mean by the fair value of the, not only the fair value of the assets, but also the debt. We would record this on the consolidated books of Multi-Diversified with a debit to each one of these assets. And this consolidated books is really something that we do only for presentation of the consolidated financial statement. It would not go on the books of Multi-Diversified's parent company like this. We would simply have an investment in TractorLing for $400,000. But when we go to do our consolidated books, We would include cash, we would include receivables. All of these items get included on multi-diversified's consolidated financial statement. We're going to talk more about consolidated financial statements coming up not long. So the key here is that we ignore, is that when we acquire another company, we ignore the cost that's on their books, and we record goodwill as the excess of the price paid over the fair value of the net assets acquired. In this case, we would have acquired $15,000 of cash, $10,000 of receivables, $70,000 of inventories, $130,000 of equipment, and $100,000 of goodwill. In all of those things, we would have totaling up to $325,000 minus the $25,000. Net purchase cost is $300,000, and that's what we get is each one of these assets. Keep in mind that we do not see the cost go on to our. In the case of this prior company that we were just looking at, the markup in this revaluation really doesn't show up. That's the revaluation of the assets that are on the books. We don't really bother with that because we don't see their prior books. And we do record the goodwill as the excess of the price paid over the fair value of the net assets acquired. Now, goodwill write-off we're going to talk about in detail in another video, but it's important to recognize that goodwill is assumed to have an indefinite life, that it should not be amortized. We don't spread it out over time. Since 2002, that's the way we've been dealing with it. And we adjust the carrying value when goodwill is actually impaired, and we'll do that in a separate video. One last thing I want to talk about is a bargain purchase. And here, it's interesting to note that you can acquire a company, in some cases, for less than the fair value of the net identifiable assets. Take over that company at below market prices. It doesn't happen very often. And the key question here is, are you forgetting to include some liability that should be out there? So as an auditor, you should be thinking, well, gee, what's wrong with this picture? Why can we get this for less than the market fair value of the assets that are acquired? And if you've accounted for all of the liabilities, then the important thing here then to remember from an accountant's point of view is that you can record a gain on the purchaser's books if you acquire a company for less than the fair value of the net identifiable assets. So there are the characteristics of intangible assets, discussion of capitalizing and amortizing intangible assets, some of the different types of intangible assets. We talked about 6 categories, and some of the conceptual issues and accounting issues related to goodwill.